Please note that due to COVID-19, we are recording the derivative remotely. We apologize in advance for the possibility of lower quality audio, but we hope that you can enjoy our podcast just the same.
This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.
Welcome to The Derivative by RCM Alternatives, where we dive into what makes alternative investments go, analyze the strategies of unique hedge fund managers, and chat with interesting guests from across the investment world.
And so there's a lot of path dependency right now with what's going to happen in the economy. Are we going to find a vaccine? Is it going to be hyperinflationary? Is it going to be deflationary? We don't really know, and therefore your only choice is first to diversify across asset classes and then to diversify across strategies.
I'm your host for the day, Jeff Malik, and I'm excited to have three real pros here with us today. The CME's Blu Putnam, Rodrigo Gordillo of Resolve, and Dan Deering of Teza Technologies. Welcome, guys.
Thank you.
Thank you for having us.
Hope everyone's happy, healthy, and safe during the lockdown. I'm here in the upstairs guest bedroom of our house, and I think we'll see everyone in a similar situation as we go to their views today. So, Blu, wanted to start out with you. Blu is a renowned economist and is responsible for leading global economic analysis and monitoring developments in price patterns, volatility, and correlations of futures and options markets. Blu holds a PhD in economics from Tulane, has authored 5 books on international finance, and has been published in American Economic Review and the Journal of Finance, among many others. Quite the resume. We're excited to have you on today.
Oh, it's very nice. Thank you.
How was Tulane? Did you know who was our Bears running back that was at Tulane?
I don't remember.
I'm forgetting the name now myself. Yeah, Matt Forte.
Ah, yes, right.
He was a good one. So quick, let's start with a little background on you, Blu. So let's start with the name Blu. That wasn't you in the Old School movie, was it?
No, it wasn't me. My full name is Bluford, and it came from my great-great-grandfather. He was the 5th or 6th of a bunch of boys, and I guess all the other kids are named William and Thomas and typical names. And somehow or another, he got Bluford, and he gave it to my dad, and my grandfather gave it to my dad and gave it to me, and that's the way it goes. And I prefer Blu.
I like it. And so how did you get from Tulane and PhD into the CME? How did that all work out?
It's a winding path. When I graduated, and the best jobs for economists were actually in the Fed. So I went to the New York Fed for my first job, which is kind of strange, actually, as to why they would hire fresh PhDs who have no real-world experience at all. But nevertheless, it was a great first job. I moved into the strategy part of the world as a global bond strategist with Morgan Stanley. Managed some money, got tired of giving advice, and went to the asset management for Bankers Trust, running the equity shop there. And then I decided that I really liked running my own businesses. So I became a consultant and had a great run at that. But after 2008, a lot of my clients weren't around anymore. And so I looked around and I thought, wow. You know, the CME is a great company. It's a great exchange. And it turns out they were looking for an economist to put that position. They hadn't had one for a long time. And anyway, I lucked out, and the timing was perfect. And as timing is always everything in the markets, you know. So it's been a great run, but CME is just a great place to work.
I appreciate that. Their stock has done pretty well over the years as well. Only a game in town. So what does your day-to-day look like? Are you a nose in books, or you're analyzing charts all the time? You're doing talks? What's the day in the life of Blu?
You know, I don't have so much a day as I have a week or a month. I do about 40 or 50 presentations a year, so it sounds like one a week, but it isn't. They get in the spring and the fall are much more intense. I do at least one video every week. I usually write a report of some sign every week. I've got a lot of internal responsibilities. I work with our finance and budgeting departments, things like that. A lot of work with our sales force. So it's a variety of things that occur during the week. What I read a lot of short articles. I read Science Magazine every week because I think I learn more outside of my field than reading other economists. Sorry about that. But anyway, that's my week.
We'll get into how economists can be like the weathermen in a bit. So I'd like to start with, we've just come through a rather historical period and just ask you what some of the craziest economic stats you're seeing during this crisis and the resulting, I don't know if you're ready to call it recession or what, but what are some of the craziest stats you've seen during this whole period?
Well, I guess the one that hits me the hardest is the weekly new unemployment claims. We had another 3.8 million people that filed last week for unemployment. Since March 15th, we've lost 26 million jobs. Every 1.6 million in the United States is a percentage point on the unemployment rate about. So, if you kind of do the numbers, we're pushing up at 20% unemployed, and it's obviously going to go a little higher. Next week, Friday, May 8th, we'll get the unemployment number for April, but that doesn't include some of this weekly data because they do that survey on the 12th of the month around then. So, we may not hit 20% on the data next Friday, a week from Friday, but, when they produce the May data released in June, we'll probably be at over 20%. And in 1933, the peak unemployment was a little bit above 24%. It also took from 1929 to 1933 to get there, so it took 4 years to do what we've done in 6 weeks. So those are the crazy statistics that, people just underestimate how many folks are hurting and how bad this really is. It's tough.
And then what do you see? A lot of talk before this was that the employment numbers were even not entirely accurate because people were removing themselves from the workforce. So is it even perhaps worse than those numbers are showing?
Oh, not really. I mean, we have issues with how we calculate the workforce, and basically what the Labor Department does is they do a survey, and are you working? Yes, you're in the workforce. Are you looking for a job? Yes. If you're not working, are you looking for a job? Yes, you're in the workforce, and nobody else is in. I mean, those numbers bounce around a lot, and but I don't think that's where the issue is. The issue is that when 26 million people lose their jobs in 5 weeks, that's the issue.
Yeah, that's a big number, to be sure. And do you think we're going to see a quick snapback of that?
No, unfortunately. A lot of very large companies are realizing their financial condition is so impaired that they're going to start back slowly. They're also seeing that the consumers won't be there right away. It's not like you flip a switch. Consumers have been damaged financially. They're actually going to save at a higher savings rate than they used to repair their balance sheets. So it's going to be a pretty slow rebuild.
I hear you. So I've heard you speak recently on what you call phase transitions, what I would call phase shifts. I think we're talking the same thing. Can you unpack what you mean by that a little bit? And ties in with what you were saying earlier, if you like to read stuff outside of economics. How's your brain working on the phase shifts?
Yeah, I mean, a lot of times when economists, can't do the math really most of the time. And then when we see something really unusual, we walk down the hall if we're in an academic institution and go to the physics department first, and then maybe the biologist a little later on to find out what's really happening. The physics of these phase transitions is kind of neat. It's like, if you take water and you boil it, it turns into a gas. We know a lot about the liquid water and we know a lot about the gas, but all the real action is at the borderline, is at the boundary. That's where the turbulence is when you're going through these transitions from one state to another. And we're in a place where we're in one that's most similarly called a cascading network collapse. That's like an electric grid having a power failure in one place and then it dominoes through 5 or 6 states around the country. It happens every couple of decades or less. But that's what's happened to the economy. We're a myriad of interconnected parts. The dominoes are falling. I have a rule in economics that the indirect effects can be 2, 3, and 4 times the size of the direct effects. And that's just because we're in a complex system. So we're in the cascading collapse phase. We're about to move into what we call a financial distress, where we're trying to figure out where we landed. That's a pretty short phase. And then we start rebuilding from there. So we'll be in the rebuilding the network phase. But that is not going back to the regular growth rate. That is trying to put the supply chains back together, companies figuring out what they can and can't do. It's a pretty difficult phase, and it'll last a couple of years.
And so, but then could it possibly just phase shift right back? Or it seems odd to me that you're saying, okay, you're going to phase shift to this lower new reality, but then it's going to have, it's kind of like an exponential move down and then a linear move back up. It seems they could be mirrored, not should be.
No, it's not a mirror. It's basically you're on a steady state upward path. That was prior to the pandemic. You fall off a cliff, and it happened very rapidly. So that's the unemployment story, the cascading network part. You land somewhere. That's a valley. You take stock of, I hit bottom. Where am I? And then you start to get up and rebuild. And that typically the rebuilding is typically slower. So, in an economy, we go up the steps and we take the elevator down. So we'll be back on the step process in this thing. So I don't know if you've ever studied chaos theory. It came out around 1990 as a fad. A friend of mine told me it was way better to write about it than actually use it. But, we're at the situation where, if you're a skier, you're at the top of an expert slope and you're really deciding whether to go down or not, or go take the bunny slope or whatever. But once you start down that expert slope, you are not going back up, okay? It's going to be a whole different path. So that's where we are here in kind of the physics of complex systems. We've fallen off a cliff. We're going to get back on our feet, but it's not going to be a V shape.
And then while I have you, I'd be criminal for not asking you on this phase shift. The prime example of that has been in the energy markets with, oil prices just falling off a cliff way more so than it seems the economy or the stock market. So what are your views on what's going on there? It's pure supply demand issue, or what do you see in the oil sector?
Well, the oil sector is very interesting. It's got two conflicting narratives going on that are working kind of against each other. So in the short run, we have this huge drop in demand. It started, in China, and then it spread around the world, and so you got this amazing drop in demand. 75% of oil is used as a transportation fuel in its refined state. We're not going anywhere. We're not flying. We're not driving as much. So when oil gets pumped out of the ground, you actually have two choices. You can use it or you can store it. So we're in a situation where the fast, abrupt decline in demand is really putting the stresses on the storage facilities. Now that will ease, because if you look down the road, the shale oil producers in the U.S., they're not drilling any new wells, but they are still producing from the old wells they drill. Now, a shale well only has about an 18-month life, give or take, and it maxes out after 4 or 5 months and just starts to diminish. So in several months, we're going to see a fairly precipitous drop in U.S. shale oil production. We know that Russia's going to cut their oil production in May. We know Saudi Arabia is going to cut in May. So what you see in the futures market, the spot market, the nearby futures are trading under $20, and then about 3, 4, 5 months out, you're over $20. A year out, you're over $30. So that's this competing narrative going at each other between the storage issues right now and then eventually the production cuts that we know are going to come down the road to help balance supply and demand again.
And do you see any of it coming from global warming and alternative energy? And is there, right, that change in demand is not big enough to make this kind of shift? But I've been hearing some people think of like, okay, let's just put the final stake in fossil fuels while it's down here. Is that realistic, or no way we can achieve that?
No, that's not realistic. But I do think that a lot of people that were focused on alternative energy are going to actually stay very focused on that. There'll be some growth. But, when the price of oil drops like this, and when the gasoline price and the petrol price for your car is down, it will have an impact. But we think that the alternative fuels are going to be a fast-growing area for the next decade. But right now, in this situation, they're not large enough to make a dent.
Right. It seems to me if you're going to go drill a new well or spend that money, now you're going to have trouble getting financing. Plus, you have this kind of PR issue of nobody wants you polluting the earth like that. So you've got another piece to the puzzle here of that's trouble for the oil patch. So moving on here, you can tell us how much money has been pumped in by the U.S. government and by, I guess, world governments.
Well, it's a huge amount of money. We have the U.S. government has promised well over $2 trillion of fiscal activity. Now, that really hasn't started up very much yet. Some of it's gotten started, but the big part of that will come later in the next couple of months and the rest of the year. And then they'll probably do more programs. I don't think we've seen the last. Most of the programs they've done so far on the fiscal side around the world, not just in the U.S., are what I call support programs. They get you to the other side of the crisis, but they are not the type of program that will increase the pace of the rebuilding. The pace of the rebuilding are kind of the programs like infrastructure programs, things like that, where you actually spend money that puts people to work doing something that they otherwise wouldn't have been doing. And so that's why I think we'll see some more rounds. On the central bank side, they are committed to all kinds of asset purchases. Just to take the Fed, they've never bought municipal bonds before. They're going to do that. They've never bought corporate debt or high-yield debt structures before. They're going to do that. And they have done a lot of other things in terms of make sure the money markets function properly, and a lot of that came from the 2008. But the Federal Reserve is on new turf. Now, I would again say that everything the Federal Reserve is doing largely makes our markets function well, but it doesn't increase the pace of the recovery. So we're still in a support method. And by the way, central banks really don't have a lot they can do other than support. Fiscal policy is the one where we're going to have these what I call regenerative policies. And they're yet to come, but I'm sure they will.
And what are your thoughts? So, right, we're just talking about oil, and that seems massively deflationary. Then we're talking about trillions of dollars in fiscal stimulus that people would assume is going to be inflationary. How do you square those two competing forces, and who do you think is going to win between the two, or do we go into a stagflationary period?
Well, I think in the short run, the short run between the 6 to 9 months, I think we're going to see price decreases on net. That doesn't mean some prices may rise. You may find that you pay a little more for a steak because we've really destroyed restaurants. Cattle, by the way, can produce steak or ground meat. The steak goes to the restaurants, so that's not selling. And the ground meat goes to the grocery stores. But so there are going to be disruptions where certain products become in very short supply. But on the whole, prices overall, the consumer price level, I think we're going to print 6, 7, 9, 10 months in a row of declines from the previous month and over the previous year. And then we'll start to see a little bit of stabilization in prices and a slow recovery. And then the real question is what happens about 7 to 10 years down the road. Now we're back. The economy's growing. Have the policymakers unwound some of the stimulus, or are they still addicted to stimulus? If they stay addicted to stimulus, that's when you see the serious inflation. So this is a little theory that they call modern monetary theory, or MMT. And, the issue for MMT is it says you can spend as much money as you want until you see inflation. And a lot of us don't believe that the policymakers will stop when they see the inflation. We think they'll say it's temporary or whatever, and they'll just keep spending. But that's going to be in the 2030s. Inflation is very hard to stop. It's very hard to start. And we're starting, I believe, from a period of modest deflation. So we'll have a long time before we have this problem, but when it comes, it might be pretty severe.
And I keep thinking back to 07, 08, these were the same arguments, right? Of all this stimulus is going to cause massive inflation, and here we are 12 years later, and we're having deflation. So there's obviously this big shock to the system, but even a year ago, we weren't seeing the massive inflation by those trillions of dollars.
Yeah,
So
but that was a little different. The 2008 was massively monetary stimulus. So it did create inflation. It was just in bond and equity prices. It wasn't in goods prices. And then we had $1 trillion of fiscal stimulus, which we immediately started to unwind. So the budget deficit did skyrocket to $1 trillion, and then and then under the next 7 or 8 years, it wound down to about half that. So we took fiscal stimulus out of the equation. For me, fiscal stimulus is far and away the most important inflation generator in the long run, because monetary policy is a more asset price situation.
And where are we at now with the budget deficit after, or assuming they put in all these stimulus packages, where are we going to be as compared with that trillion after the financial?
Right. Approximately by the end of this year, we'll be over $2 trillion, and by the end of 2021, we'll be at $4 trillion or so. So we'll be up at 35% of our GDP, a pretty massive expansion of debt. Now, at the same time, I don't really look at just government debt. I look at government plus private and corporate debt. And we believe that corporations and private citizens are actually going to pay down a lot of debt over the next 5 years while the government debt goes up. But the government debt the rise in debt is going to swamp it. We're going to be way more indebted. And by the way, the more indebted a country is, the less likely a central bank is to raise interest rates, because it can cause way bigger problems when you've got way more debt and you're way more fragile.
I hear you. All right, I think we're going to move on to talking with Rodrigo and Dan now. But thank you, Blu.
Oh, thank you.
Very insightful. I'll let you with the last comment of anything that keeps you up at night or scares the bejesus out of you on this crisis.
Oh, you already hit it. The debt scares me down the road, and I think a lot of people are underestimating the depth of the crisis even still. So those two things do scare me.
And even, I'll follow up on that quickly, just even without, a lot of people I'm hearing, they're worried about a second wave that will cause another crash or another leg down lower in the markets. But you're saying maybe even without a second wave of the virus, just the pure monetary environment may be problematic.
Yeah, that's correct. I'm worried about the economics. I'm not an epidemiologist.
None of us are, so that's the problem. All right. Thanks, Blu. That was fun. Now I want to move over to the guys who unpack all that data day in and day out and turn it into actual trades. We have two talented asset managers with us today, Dan Deering of Teza Technologies and the Catalyst Teza Algorithmic Allocation Income Mutual Fund, and Rodrigo Gordillo of Resolve Asset Management and the Rational Resolve Adaptive Asset Allocation Mutual Fund. Welcome, guys.
Thank you.
Thanks. You. How's everyone surviving quarantine?
Physically
There's an adjustment
fantastic.
period, that's for sure.
Yeah, emotionally with the children, trying to homeschool them is possibly the most draining thing I've ever done in my entire existence.
And then I'm assuming I'll go with you first, Rodrigo. Just you guys were trading-wise and your firm-wise, there's been no dislocation or anything. It's all.
No, we went remote a couple of years back, and in fact, every one of our employees are work from home 2 to 3 days a week for years. We have a decentralized workforce as well, so it forced us to use everything that everybody's using: Zoom, GoToMeeting, a lot of asynchronous work being done already. Employees in Germany and in Montreal and Cayman and all over the place. So this is a par for the course for us. Didn't miss a beat. It's been pretty fantastic, actually.
Got it. And Dan, how about you guys?
Yeah, certainly no displacement on our side. We're used to working across 3 different locations with pretty evenly spread from our employees. So we've continuously worked either from home or kind of a distance relationship anyhow. So I think the transition was quite easy for us. I think the biggest issues that we've had and probably others have had as well is just, I think, I don't know that the internet has been was particularly made to take on the type of traffics, or at least in certain congestion areas, and that's always a little bit painful. But I think that's otherwise everything else has been good.
Yeah, and we saw it here in Chicago. Dan, you're in the Chicago area along with me, but we saw it, was it 2 weeks ago when the public schools finally figured out their e-learning and online learning? And then there was this wave of new internet users, and a lot of people saw things slow down. So, Dan, I'm going to stick with you here. So you're CFO at Teza, a global quantitative investment firm based on talent, science, and innovation that's in the process of making the transition from a prop firm trading your own capital to an institutional asset manager trading client funds. And your unique strategy you're doing in the mutual fund is a systematic global macro type model with a high focus on AI and machine learning and order book management with the symbols TEZIX. So can you give us the elevator pitch on what you guys are doing in that strategy?
Sure, absolutely. Why don't I take a second? I'll help paint the picture a little bit and talk a little bit about the company itself and where we came from.
Please do. Yeah.
So Teza was started in 2009 by Misha Malayashev after he had built out Citadel's high-frequency business. And there we spent several years building out the research and technology platforms that we deploy today and in running our proprietary trading business. In 2014, we actually expanded into the advisory business in the form of a hedge fund and managed accounts. And it's here now in 2020 where we're taking that goodness and moving it over to the 40 Act space. As I mentioned before, Teza's 57 employees across 3 different locations here in the U.S. We do have a presence in China as well. And really, we have about 80% of our workforce is focused specifically on quantitative research and technology development. So that's a little bit about Teza. And paints the picture a little bit about who we are. Going to the fund and what the fund's all about. So the fund is managed completely quantitatively and systematically, as you might imagine. The core of the strategy utilizes 100% futures contracts. That's kind of our bread and butter. When we look at it, the fund, we think of it as a combination of a top-down asset allocation approach combined with kind of a bottoms-up signal generation that adjusts daily for market conditions. And so when we think about it, we kind of start from the balanced asset allocation perspective. Here we're allocating based on risk. So in many ways, the fund is similar to a risk parity approach. To start with, and then this allocation from a balanced perspective, we do so across 2 different dimensions. We look at geographic, and so we're looking at investing in and allocating to North America, Europe, and Asia, and then also by product class. And so by product class, we're looking at stock indices, government bonds, and commodities, really with a starting point of around 40-40-20 on a risk allocation basis. The one thing that I'll note is that the stock and bonds, those particular classes, we keep a long bias on those products. We expect those to appreciate or produce income over the long haul. Meanwhile, on the commodity side, we are long short, as we just don't have that same expectation. Oil being an example of one of those. The next step is kind of, I think, what helps differentiate us a little bit from others. Is that we look and we rebalance and reallocate on a daily basis. And we're doing so to kind of manage different market conditions. It's here is where we look to apply information and research really at various levels of granularity. We'll look at market macroeconomic information in our research all the way down to pre-trade exchange level detail. And so, essentially, we're then using information from this data and from these forecasts to kind of reallocate to different buckets in between the buckets. Here I'll mention, our history is really high frequency, and so we're strongly rooted in the principles of kind of the supply and demand dynamics, kind of at the micro level on the market, and we use a lot of that information. Both real-time, intraday information in our research to really kind of help us drive these forecasts and asset allocations.
Great. So, Rodrigo, you're the president and portfolio manager of Resolve Asset Management, who do private funds, manage accounts, and sub-advise on mutual funds, all around systematic asset allocation modeling. We'll be focusing on the Rational Resolve Adaptive Asset Allocation Mutual Fund. RDMIX is the ticker, strategy today. So similarly, give us the elevator pitch on what's going on inside of the fund.
Sure. Yeah. I mean, this is a strategy designed to. We've kind of renamed it over the last couple of weeks as the pandemic portfolio. We recently did a podcast on that because it is framed from the perspective of kind of everything that has been outlined today by Blu, dealing with having an ability to deal with phase shifts across global economic dynamics, right? When you're dealing with a complex universe that has a lot of phase shifts, you want to make sure that first and foremost you have an asset class universe that can deal with different economic regimes. And so we'll get into the specific details there. But the first thing that we do is make sure that we get exposures or have the ability to get exposures to asset classes in the equity space, in the commodity space, in the sovereign bond space, because they're going to react differently to different economic regimes. And we also start with this idea of a do no harm portfolio, right? Where if you don't have a view as to where these markets are going to go, then you want to make sure that you're allocating to these asset classes an equal risk contribution to start as a starting point. And then how you decide to overweight or underweight or eliminate asset classes from that do no harm portfolio is where we add our quantitative, macro factor based views. And we're not looking, unlike Teza, which is looking at the micro factors, we're looking from the top down. We are really identifying global macro factors. Everybody talks about factors in the security selection space, like, momentum, small cap, value, et cetera. We don't deal in that space whatsoever. We deal in the factor on the macro level, which we can get into why we believe that to be much more robust in the long term, and the alpha that you can extract from there is likely to provide solid returns in the future. But the factors that we look at are a wide variety of factors, and we keep adding to them. But you're looking at things like momentum, trend, carry, mean reversion, skewness, mean reversion to carry, conditionalities that we're looking into from the machine learning perspective, and identifying as many different factors as possible to help us decide at any given point what asset classes should be overweight, underweight, or eliminated. And from that perspective, you're able to really navigate, we call market surf, across different dynamics, whether it's growth, high growth, low growth dynamics, or high inflation, low inflation dynamics. So in a nutshell, it's designed to be, we like to mention that it is a completion portfolio. More often than not, the vast majority of investors and advisors have a very plain 60-40 domestic home country bias portfolio. And you're missing some of these key elements of gold and commodities and global sovereign bonds and so on, because they're tough to trade. People don't know how to trade those things. And they recognize the value in diversification, but they also recognize the complexity in trying to put that in a portfolio and explain it to clients. And the idea would be to have a portion of your portfolio to be completed by methodologies such as Teza's and ours to help investors maximize that diversification and navigate markets a bit better.
And so you guys did a nice white paper a few years ago on a ski shop needing to diversify their revenues and selling bikes in the summertime. So it was a pretty easy thing to understand. So essentially the fund is adding many different types of bikes and even paddleboards and ATVs and a lot of different things to basically diversify that revenue and make sure you don't go bust.
Precisely right. In a way that adding 2,500 U.S. equities in a portfolio don't do, right? Those are just adding more bikes to your portfolio. That's why the asset allocation level is so much more important. I mean, if we talk about this inflation story of my background, why I've never traded a stock in my career really, is because I came from Peru, born and raised. And the reason I emigrated to Canada was because inflation went from 20%, which was normal, it's kind of normal still for many Latin American countries, to 7,200% in 6 months, right? And that impacted me. I saw the macro impact to a portfolio, but not everybody lost in the same way. You had the people that had savings, like my grandfather, who had roughly the equivalent of $1 million in cash, had recently retired. His savings went to zero because it was in Peruvian soles. And my next door neighbor, who was literally about to be evicted from his house because he couldn't pay his mortgage, was able to pay down his mortgage with a couple $100 in U.S. U.S. dollars that he had under his mattress, right? So
Wow.
these phase shifts, these really macro level events are what matters the most to survival. And they do act very, very differently. Gold will act very differently from equities, will act very differently from bonds in economic scenarios that will vary. So, and we can get into that a little bit later.
And just to follow up on that theme real quick, then we'll come back to Dan. Your recent podcast I listened to the other day was quite good. The as you said, the pandemic portfolio. So again, that concept is we don't know what's going to happen in this thing. Just make sure you have what you call do no harm. I would just say a base, just be in your football terms, be in your base defense. We don't know what the offense is going to come out with. They might run, they might throw. Instead of betting the farm on what they're going to do, they're going to run right over here. Let's just be in our base defense and
don't get sucked into any particular narrative that feeds your bias, right? Start with, if you don't have an edge, just do no harm. Just do equal risk contribution across a wide variety of asset classes that we know act differently depending on what's going to happen next. And from there, if you feel like you have a long-term edge, then you can start tilting, whether it's an order book style prop trading like Teza, or factor-based like we do here at Resolve. There's ways to start tilting thoughtfully, and you also want to diversify that, right? Don't also buy into all of my narrative about my strategy. Diversify my strategy with others, right?
Agreed. No offense, but agreed. Yeah. So Dan, coming back to you, I cut you off before. Did you want to finish your thought on that, or want me to jump into the next question? You're good. So
I think that just the last.
Go ahead.
I was just going to say the last thing that we do as a part of our portfolio construction is we do bring all of that back to a centralized target for our volatility, which just allows us to manage the volatility regimes within the markets a little bit better, and that has obviously been very important over the last several months.
And so how do you square, and do you get comments from investors and whatnot of like HFT's gotten a rather bloody nose, or right? It's kind of been looked at as the evil in the U.S. That they're taking advantage of small investors or whatnot. What's your thoughts on that? Can you clear up any misconceptions on that?
Well, I don't think we've had many responses recently from investors that have had a particular view on HFT. I think we try to explain kind of what the advantages of the system are and what we try to do. And I think once people start to understand the value that is provided in some of the liquidity that's provided from the HFT firms, they start to understand a little bit better. But it's easy to point fingers at someone who's been successful. So we kind of take that with a little bit of a grain of salt.
I hear you. And you'll see here, like using some of those concepts to in a mutual fund that retail investors can get into. So you're kind of bridging the gap between those two worlds and showing that, hey, this isn't all some evil mathematician up in his ivory tower. So let's get into that a little bit. You're both heavily quant-focused shops. You both use different flavors of AI and machine learning in your processes. Dan, coming back to you, can you talk a bit how firms like yours use AI and machine learning in your process?
Sure. So, and just to be straightforward, just to make sure everyone understands, in the fund itself, we don't use any high frequency trading. So, it rebalances on a daily basis. But what we do is we use information that we've learned from the high frequency space in the way that we've done our research and applied it here to the fund. Generally speaking.
And I'll just ask a quick question. Does that, a simplistic example of that would be, hey, I know if I'm going to go buy 100 shares of IBM, that's not what you do in your share, but just for sake of example, if I'm going to buy 100 shares of IBM, I'm not going to naively cross the spread and pay an extra 5 cents more for that. If my HFT background and my models say like, no, you can wait and buy it at this better price. Is that similar? How the HFT experience has bleeded over into the mutual fund?
Well, that specifically is looking at really kind of your benefit that you're going to get on your pure execution, which is kind of one level down really from where we bring it here into the fund. What we do is we bring information from that granular level. We compile it together and understand how these, whether it's relationships with other assets, how those are changing over time. and really use that granular level data that can be, can be pre-order book, can be order books, so pre-trade, or can be post-trade as well to help us identify signals of where we think market conditions are going. So we're not necessarily using it to take advantage on the pure execution piece, but it's that information that bubbles up.
Got it. And then back to the machine learning question. So how is that being worked into the process?
Sure. Across the board at Teza, we use AI and machine learning in different facets. We specifically have a team dedicated to researching and providing tools around deep learning and neural nets. But that's still a pretty new area that we focus in, and that sits mostly in our hedge fund product. But here what we're doing is we're taking and we're using machine learning in ways to really optimize whenever there's multi-dimensions that we need to be optimizing against, whether it's for portfolio construction, some risk aversion, when we're looking at fitting the models themselves, from the alphas and the signals that we build from the ground up. We're using it within those processes to kind of optimize what the forecast is going to be.
Got it. And Rodrigo, I'll come back to you quickly. How you guys look at AI and machine learning, and what you think are some of the biggest misconceptions out there about it.
So the thing about machine learning is that it's very multifaceted, as you can see from this graph, right? And when it comes to investing, you can apply machine learning to very different areas, and I think that a lot of investors don't really internalize or understand. I mean, the idea of machine learning tends to be seen as something that can predict prices better. So find me a system that can make me a lot of money by telling me where a market is going to go over the next day. And that is definitely part of it. But at Resolve for the last 10 years, you can see in the red area top left there, there's a ton of value in the portfolio construction level. So clustering, you're dealing with 70 different futures markets. They're all very multicollinear. There is complexity in the highly correlated nature of those asset classes. Are there ways to use unsupervised machine learning to find better clustering systems and create better weighting schemes? So that's an area that is not about predicting the future P&L of an asset class, but rather in creating a more robust balance for the portfolio. Then there's supervised learning, right? This idea that you're not just sticking this machine learning algorithm in the markets and asking it to give you something back. It's more using old tools, old technical analysis tools, or momentum-driven tools, or mean reversion tools that you feed into the system and say, look, here's some structure to the market, and I want you to find me conditionalities between these structured elements to find me something that might be a bit predictive. So we're looking at regression, we're looking at classification. And then there is the reinforcement learning, which is more like gamifying machine learning, which is really the what you hear in the news today with chess masters, Go, poker players, where you're really saying, I want you to try to beat yourself or play this game and learn from playing yourself iteratively until you find something that does better than everything else. And so machine learning is it's very vast, it's quite varied. There are many ways you can benefit from it, and we use all of those dimensions at Resolve. And of course, the toughest one is always going to be that reinforcement learning side, where you go from, like, our hedge fund applies to supervised learning and reinforcement learning. When you go retail, it's going to be tough to really make that widely accepted, because it requires a level of explanation that you may not be getting in reinforcement learning. So Al, if you go to the next slide, the biggest problem and obstacle with just using, here's a machine learning technique that I cannot explain, and let me know when you see that next slide, because my punchline won't work otherwise. Is that if you can't explain it and it goes wrong, maybe it goes wrong momentarily in a way that you've seen it before on your back test, you're still going to lose all your money from investors, right? So a key aspect of all this machine learning stuff is creating the systems behind it to be able to understand what's going on and explain it. And that is a big process for the ML people out there. And then my 2 cents on that.
Right. Yeah, I totally agree with that. The narrative, people have gotten so used to having a narrative around why things go up and down, regardless of whether it's true, that they're still going to want that narrative, regardless of whether it's true or false. And Dan, coming back to you, so what would you say some of the problems of investors getting this asset allocation mix right? Do they need to be right, the perfect allocation of the perfect percentages in each thing, or is it more important to be consistent?
Yeah, I think that's a good question, and I'll maybe sidestep it a little bit from the standpoint of the way that we've looked at that problem is we tried to address it at the same time, because really the relationship of getting it right and being well diversified, those two kind of go hand in hand, and so I think the way that we've looked at it is you want to make sure you have a good process that understands these relationships under the time frame that you're trying to match up the particular allocation. If you're investing over a shorter period, it's going to give you a different output as if you're investing over a longer period, and how you're going to manage the particular allocation. And so what we do is when we're looking at on a daily basis, we're looking at relatively short time periods that allows us to modulate our positions quite heavily from one to the next, and we think there's an advantage in doing so. And I think some of the reasons why we do it, maybe others don't, is that one is whenever you're moving parts, you do take on a different risk, and so you have to address different risks during that short period of time. And so it's a balance between the allocation and kind of taking a particular view. It's a place where it's a difficult thing to kind of give up what we would say around the office is the free lunch of a balanced portfolio, right? I mean, that's what Mark Fitz came out with in was it the 50s or 60s, and so you really got to be good with taking that risk. And I think the other is a lot of people are in products that try to be well balanced, but they're in products that they just can't rebalance in very quickly, especially if they're not in an exchange market. But even if you are in certain products, you're going to have heavy costs if you rebalance all the time, trying to manage that relationship. And so doing so in the futures market, it allows us to manage that risk well and manage the costs of it as well.
And so can you give us an example? I'll throw out an example. Tell me if I'm off base or close of. Right? Someone might say, if I'm looking at it over 100 years, I definitely want gold in the portfolio. But you're kind of saying your approach is, hey, I don't need gold this week, or I don't need gold today. I know I want that type of exposure over the long term, but in the short term, based on our micro level looking up, we can say gold shouldn't be in the portfolio, or it should be a small percentage this week or this day.
Yeah, so I think that's right, and I think from that perspective, you may not necessarily want to get completely out of gold at any point in time, because your forecasts, if you could forecast correctly 100% of the time, you just take a bet every single day. Yeah. So you want to manage that dynamic between the two.
Got it. And Rodrigo, back over to you. What are your thoughts on why it's so difficult for people to get this asset allocation piece correct?
Well, because everybody has very strong opinions and they follow a narrative and they want to be in one single asset class at any given time, right? It's just human nature to believe strongly in things. And as Peter Bernstein said, that the truth is that diversification is an explicit recognition of our ignorance. And a lot of people don't like to claim ignorance. So you have to balance your hubris and what you believe to be your predictive value versus your attacking the market from a place of humility, and balancing those two as markets evolve, right? So if you put up the slide 5 in the main presentation, this is just the framework that we live on at Resolve, which is this idea that you want to be, again, diversified across different markets as often as possible, because each market reacts very differently to two dynamics, which is inflation shocks or phase shifts, as Blu said earlier on, whether it's rising inflation or slowing inflation, and growth shocks, whether it's slowing growth and accelerating growth. And depending on what the cross section of those two dynamics is, we can predictably say what asset classes are going to do, right? And so the truth is that If you look at the next slide and we look at real life examples of secular trends, periods of inflationary boom like we saw in 1999 and 2007, well, we can predictably say that if you have high inflation shocks and high growth, you're going to have these big winners in asset classes, which is commodities, gold, real estate, and so on. In deflation, accelerating growth and falling inflation like 1982 to 87, you're going to have developed equities and bonds do really well. In deflationary busts like today, you're going to have gold and commodities do really well. And in periods like the 70s, you're going to have, in deflation, is gold and bonds and sovereign bonds do well in the deflationary bust, which is what we've seen this year. And then inflationary stagnation, you're going to see gold and commodities really outstrip everything else. So we can predictably know how things are going to react in different regimes. What's tough to do is know what regime we're in at any given time, right? And so that's where you need to infuse a little bit of humility. If you go to the next slide, this is the idea of preparation over prediction, right? Preparation is the fact that had you come into 2020 with a balanced portfolio of global asset classes, then predictably, now that we know that it was a deflationary shock, predictably, we saw, this slide after that, we saw that the two big winners in 2020 have been, everybody's talking about this bear market. There's two bull markets out there, and it's sovereign bonds and gold, right? As explained by the model. So this is where preparation is important, and then you can infuse a little bit of prediction, right? Every year there's these secular periods where we know markets ebb and flow. Then there's a microcycle, which is every year there's big winners and big losers across asset classes because in the year, in the quarter, in the year, different inflation and growth dynamics change through time. So even having a balanced portfolio is great. Risk parity strategies across the board have done fantastically well, with the exception of one big blow up, which took the headlines. But the vast majority of these risk parity approaches have done well. And then if you infuse a little bit of hubris and you put your own twist to how much you want to overweight and underweight, you might be able to do a little bit better, right? So again, you don't want to go full hog. You want to have a balance between the two. And understanding how markets work, especially on the asset allocation level.
Love it. Switching gears a little bit, Dan and Rodrigo, we'll start with you, Dan. What sticks out most with you guys about some of the stats Blu threw around, and just how hard it is for a fundamental approach to asset pricing right now, given the wild swings in these economic metrics? And basically, how happy are you to be a quant manager where you don't have to sort out what's noise and what's signal? Although I'll argue you actually do have to sort that out, but in a different way.
I think the biggest numbers that are just really amazing is the speed and the acceleration that has happened in unemployment, and I think what makes things difficult here is really seeing what is that going to mean, and looking back over history, there's very few instances where we have good information of when unemployment's moved this quickly, and how it will respond over time. And as Blu said, his belief is that it'll take a while for that rebound to happen, just as the natural forces of business and economics is going to require time to do so. And so I think on a pure absolute basis, being able to put valuations on assets today is really very, very difficult. I think, we're still in a period of, certainly within the stock market, where most of the movements are based upon news and sentiment rather than economic information, because economic information just doesn't add a lot of value right now. Once we get to a point, if we have a vaccine, if we have levels of new cases declining considerably, we'll start to look back at the economic news, and that'll start to help drive some of the valuations. But for the time being, on an absolute basis, it's hard. Now, if you look at it on a relative basis, there's definitely opportunity, and that was very easy to see with, you probably within the first 24 hours could have picked out a handful of stocks, put those relative to other groups, and definitely found ways to be successful in managing a portfolio during this period of time. But on an absolute basis, I think it's really difficult. From a quantitative perspective, I think it kind of echoes those sentiments from a grand economic perspective. I think it's hard at this point in time. So staying diversified is important. I think it is helpful, and we've seen that it's much easier to look and understand things at a very short time horizon when we're looking in periods of uncertainty. And so from our perspective, that's been a good thing where we've been able to see a lot of information, especially within the exchange dynamics that have been beneficial. So I think there's advantages. It just depends on how on really the tools that you have and how you're taking those to put your positions on.
Rodrigo?
Yeah, look, I think we spent a lot of time internally with partners arguing about what's going to happen next from an economic perspective, and we've realized that none of us know or have a clue as to what's going to win out. It's there's a lot of great narratives, and the economic narrative might be right, but it might not be reflected in the market. These things, whatever's going to happen, whatever's already part of the narrative today is already priced into the markets. Here's what we know. We know, first of all, you want to have exposure to asset classes that diversify you against these regimes. You also want to have a varied or a variety of alpha factors, because another thing that we did in our pandemic portfolio is we had an argument internally about which factor was going to do best in this environment. When we said clearly it's going to be trend, right? Because it captures the trend, it can go short or whatever. It wasn't. It was carry. I thought carry was going to be the worst. So as we did an examination of not only just an examination of what is likely to do well across these different strategies, and looked at a lot of bear markets back to 1990, and every bear market's unique. Every bear market has different path dependencies. Bear markets are a series of bull markets and bear markets that take two years to evolve. And depending on how those happen, your portfolio is going to do differently, all right? And so there's a lot of path dependency right now with what's going to happen in the economy. Are we going to find a vaccine? Is it going to be hyperinflationary? Is it going to be deflationary? We don't really know, and therefore your only choice is first to diversify across asset classes and then to diversify across strategies. And the last thing that we'll say is that what is clear is that your bet sizing can't be the same right now, right? You can't place the same dollar amount in a conviction trade today as you did in January, because the volatility is 5 times what it was, right? And I think a lot of people conflate volatility with opportunity here. There's a lot of retail, and I think one of the highest searches in mid-March was, how do I buy stocks by retail investors? And they're seeing it as an opportunity, but all it is a levered bet on a stock, right? If it's 5 times more volatile, you're just 6 months ago, you should have just bought whatever your conviction was, just lever it up 5 times, right? So I think a key thing when we don't know is diversification across strategies, asset classes, diversification across strategies, but then make your bet size commensurate with the current environment. And I think I recently read this, people are starting to feel like we're coming back to normality. But the truth is that the S&P 500 just posted the most daily swings of 3% or greater in more than a decade, even as stock markets hit a 5-week high. The S&P also booked its 38th session gain of at least 1% this year, last Tuesday, surpassing this year's total. Wow. So we're not in normal markets.
Yeah.
And people think we are, and they're putting money back to work as if it was. Our view is much like Teza, everything that we do is we bet size, we volatility size. So our strategies have different volatility targets. The adaptive asset allocation strategy targets 12%, which is reasonable. It's like a balanced portfolio. And what that has meant throughout this process is as volatility expanded, our conviction has gone way down, right? There's more volatility, less price discovery. And so you want to make sure that as you deal with this market that you don't get too overconfident. You put the right bet sizes in. And I think I can kind of one of the benefits of that is that you eliminate the left tail, or you really reduce the left tail risk of your portfolios if you're vigilant about expanding and decreasing your growth.
And I think some people naively feel, oh, we just saw the left tail. Now I can get in and
that's right.
Have no risk of a left tail, but there can always be a left or tail.
And I think Dan can kind of echo my sentiment here is that the old saying that there are old traders, there are bold traders, but there are no old bold traders, right? And nobody in the prop trading desk is taking big positions right now. Why should retail investors be doing so?
Yeah, and the ones that did got carried out. Some notable busts there. So we're going to wrap up. We're going to go to a couple questions we got here. Blu, start with you. I'm going to conflate two questions here. So one, you mentioned that inflation takes years to catch up after the use of stimulus. Can you touch on why this has such a lag? And then two is sticking with inflation. Rodrigo mentioned the 7,200% inflation in Peru. We've seen it in Argentina. Is there, I think, talking of home country bias, U.S. folks would say, no way that could ever happen here. So kind of a two-parter. Why is there the lag, and could we ever see hyperinflation here?
Yeah, well, it's no way it could ever happen here. You really don't want to ever say that word. But anyway, that's not a prediction, by the way. It's just an observation on saying that. Bernanke wrote an interesting paper in around 1999 or somewhere telling Japan what to do, and the implication was it couldn't happen in the U.S., but then he pulled out all the same tools when 2008 happened. But anyway, inflation and the actual inflation is very much related to inflation expectations, and people are fairly slow to adjust their expectations. We had slowly rising inflation in the 60s and then much faster in the 70s, but it didn't really get absorbed into the narrative as we had a huge inflation problem until OPEC kind of triggered it in 74. And on the way down, we hit 13% inflation in the U.S. in the 1980-82 period. You may remember the long bond, the 20-year bond was at like 14% or something. But the inflation expectations, high inflation expectations hung around for all the way from pretty much for 20 years. I mean, 20 or more years, because that's the rally in the bond market, that just kept on giving. But that was because people were taking a long time to realize that inflation really had been tamed sufficiently. So that the feedback loop with expectations versus the reality is exceedingly slow for countries that have very little inflation. Now, once you start having a lot of inflation, then you start indexing everything to it. Your behavior changes and how you keep your money, and then it happens a whole lot faster. And then typically, when you have a huge amount of inflation, you don't solve it until you reissue the money and rebase everything. So it's a pretty drastic solution when you get into the hyperinflation situations.
Great, thank you. And then had another question here from the audience of whether the two funds go short. So if you had something like the oil going down, could you capture that downtrend? Dan, we'll start with you.
Sure. Yeah. So as I mentioned, we go long and short commodities. We're in the energy sector. We have been negative in the energy sector. So yeah, we definitely will go long and short depending upon kind of the conditions that we see.
Have negative meaning you've been short, not negative P&L?
Correct.
Got it. Rodrigo?
Yeah, so similar to Teza, we go long flat. Well, maybe Teza doesn't go flat, but we go long flat financial assets because of that positive carry and positive risk premium that we would expect from equities and bonds. But we have the capabilities of going long short currencies and long short commodities because they don't have an expected positive risk premium. Right. So yeah, I mean, and also I will mention that as one of the charts that we put up there was, is there really a need for shorting in order to be able to thrive in different economic regimes? And I think that chart really shows you don't. A lot of P&L from trend managers, long short commodity managers come from being long bonds. I always like to say that Druckenmiller, everybody thinks that he made a lot of his wealth in the bear markets, and everybody thought he's just a really good timer to shorting the S&P or the little markets. He self-admits that most of his money was from treasuries and long the Eurodollar, right? So there's this belief that in order to have absolute returns and do well in crises, you need to go short is just not well founded.
And then there's a question here, Rodrigo. You mentioned risk parity, and this kind of goes in with that. Is your fund a flavor of risk parity?
There's a piece there that you guys can read that we call risk parity with factors, right? And I
think we have a slide we can pull up that you had on risk parity.
Yeah, I mean, just the report on it, and you'll see that the idea here is start with preparation, and then add your prediction on top of that, right? So it kind of the same thing that we've gone through today in today's podcast and webinar. You can see that in this is just a research report. It's not exactly what we run in client portfolios. It's just the idea of what happens when you add macro factors to risk parity. The yellow is the kind of P&L from adding the factors, and the blue is just risk parity. So a portion of it is risk parity, and the rest is tactical bets. And if you scroll down a little bit more, figure 7, you'll see the differential in terms of what the allocations will be versus a risk parity portfolio. So the idea here being a risk parity believes that there's a positive risk premium for equities and bonds all the time. We believe that there's a positive risk premium in equities and bonds some of the time, and so you want to act accordingly. Right, so that chart right there shows periods where we differentiate from the risk parity portfolio. And because it is an interesting thing with rates at bond rates at 50 basis points, and whether a risk parity portfolio on its own is going to do really, really well. No, a basic risk parity portfolio is likely to do, half of what it has in the last 100 years. And so you want to be a bit more nimble around it while maintaining some humility.
I'll throw out a question to all three of you based on negative interest rates and having fixed income as part of the portfolio. So Blue, I think we did touch some negative rates at the depths of the market there in March, right? But what's your forecast, or what are you seeing for the possibility of prolonged negative rates in the U.S.? And then after that, guys, just what would negative rates do to your trading, to your portfolios, if anything?
Well, I don't think the Fed's going to go to negative rates. I mean, negative rates are a tax on the banking system. I don't think this is exactly the time you want to raise taxes. Negative rates.
The Fed for that?
Yeah, the Fed. Negative rates, the European Central Bank put them in. It didn't help them at all. In fact, from the time they put them in to the time just before the pandemic, it really no help at all, and maybe even hurt. Japan's gotten a lot of pushback. They've on it as well. So, to me, negative rates have already been proven wrong. That doesn't mean some people don't like the idea. They're very linear thinkers. They think if 3 is better than 4, if 2 is better than, whatever, then let's go negative. That's just linear thinking, and the earth is not flat. But there's still a lot of flat earth people out there. Now, there are people that are doing interesting options strategies that have several legs to them, and sometimes one of the legs does have an option in the Eurodollar rate futures that implies a negative rate, and so we do see some volume trading on the futures, on the options on futures exchange, but typically those are not outright positions. They are usually part of a more complex structure, and and they're and it certainly could happen. Just because I don't think it's going to happen doesn't mean it's going to happen.
Yeah. And guys, how about you? What would that do to your portfolio allocation and performance, if anything? Start with you, Dan.
Yeah, I'll go ahead and sure. So obviously having lower rates, over the long term, holding that asset's going to give you less return there and less opportunity for return. But in the way that we approach kind of our construction, we're more interested in kind of the volatility and the correlation of the interest rates to other products. And so, you lose some opportunity there in one aspect, but then you gain some other opportunity as well, as it relates to the other products. So will it change our approach? It will change the overall construction reasonably. But the things that we're looking at to take advantage of, it doesn't necessarily change it.
Got it. Rodrigo?
Yeah, I think, look, it's just more of the same, right? One of the benefits is that we can go zero bonds if we need to, but that's not to say that we can't make money as rates go from 1 to -2. If you look at the German bond complex that went to negative rates, if you're buying it for capital appreciation, throughout that ride, people think that if you had known that German bonds would go to negative territory, that you shouldn't own them. In fact, an investor who owned them over the last 10 years has made a lot of money.
Great.
Right?
Yeah.
So you may not want to hold it as a strategic holding because you're going to have lower rates or negative rates, but as a tactical holding, it could provide tons of opportunity. And as Dan said, you're going to have diversification benefits from it too, right? The zigging and the zagging, when you put two portfolios together, one may be in negative territory, but the other two may be in positive territory. You put them together, your risk-reward ratio is higher, even though you include an asset class as losing money, right? And I think in the PowerPoint that we're going to share, I did a webinar called the 90 Years of Risk Parity, where we go through a 40-year period where treasuries lost money, like for that whole period, a 60% drawdown in treasuries,
Wow.
which is the fear for most investors in 60-40 and risk parity. But if you have true risk parity, you would have been making money in equities and commodities in an equal risk perspective, right? And so two of the three engines were making money. The combination of the three makes your Sharpe ratio or your return to risk ratio higher, and you actually made a lot of money in a risk parity portfolio. You actually beat equities if you did a risk parity portfolio at the same level of risk as equities without having to predict that equities were the best performing asset class from 1940 to 1980. Right.
And
so just because we're going to have a bear market, may have a bear market in bonds, does not mean you wouldn't benefit from owning it in a do no harm portfolio.
But it also speaks to just a naive 60-40 portfolio at zero or negative rates is.
Oh yeah, you don't want that.
You want some dynamic, adaptive. You want exposure to that asset class, but not just a naive 40%.
First of all, from the perspective of 60-40, 60% equities actually represents over 90% of the risk of the portfolio. So that is that is not a 60% equity, 40% bond portfolio. It is a 90% equity bet, 10% bond. So in that perspective, that's one thing. You're missing also the third engine, which is inflation protection. Yeah. Right, this is the key thing that I see around when I talk to every advisor. They know they should have some inflation protection there, some gold, some commodities, but they have a hard time explaining it to their clients. So you need something that has the ability to do well in an inflationary regime. And right now, a 60-40 portfolio in an inflationary regime during the 70s annualized at zero in real terms. So if you don't have that third engine, you're in trouble. And that's going to do okay for you. You may need to use a little bit of leverage to increase your return. But then the third phase is, getting comfortable with being uncomfortable with a little bit of tactical allocations.
Agreed. All right, guys, we're going to wrap it up. We're going to post this out to our new podcast, The Derivative. So listeners, make sure you go subscribe to that to get more interviews like this. Any final comments before we drop off, guys? Blue, we want to know what that is over your left shoulder.
The Woodstock poster.
Ah, I love it. Yeah, got it. 3 days, 4 piece, and music. Got it. All right. Well, thanks, guys. We'll post all the materials and whatnot out there, and thanks, everyone, for listening. Have a great day. Stay safe.
Thanks, Jeff, for putting this together.
Thank you.
Thanks.
All.
Listening to The Derivative. Links from this episode will be in the episode description of this channel. Follow us on Twitter at RCMAlt and visit our website to read our blog or subscribe to our newsletter at rcmalt.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you.